Good morning, everyone, and thank you very much for joining this webinar this morning. My name's Seb Maley. I'm the Chief Executive of Qdos, and I'm joined today by Nigel Nordone, who is our Head of Tax and a very experienced former Inspector of Taxes with HMRC. Just a couple of housekeeping notes before we begin. We will run a Q&A session at the end of the presentation, but please feel free to submit your questions throughout. You should be able to see the Q&A option on your toolbar, and it's set so users are only able to see their own questions. We wanted to put on a short webinar to hopefully raise some awareness and understanding of the MSC legislation, which has become a very prominent talking point over the last few weeks. Obviously, there are a large number of contractors who are directly affected as we speak, but it's important that any contractors have knowledge of the rules, particularly given our old friend I35 has taken all of the limelight in recent years. Now, you may well be aware that there are two live cases that we know of at present. The purpose of this webinar is not to analyse those cases specifically, but to look at things on a broader basis and give some high-level advice on steps that you can potentially take to protect yourself. So just a very brief introduction to who Qdos are. We were founded as a tax consultancy firm. We've been around since 1988. Our focus over the last 20 years or so has been on status and I35 in particular. And we've been very busy over the last few years helping people to get through the reforms to the off-payroll rules. We provide services to both contractors, which was always our background, but also now to the agencies and the clients who engage them. So in this session, we'll be giving a background to the MSC rules, an introduction to what they are. We'll talk about how they affect contractors and other parties, a brief explanation on how they differ from I35. We'll give some advice on what contractors can do, and then we'll open the floor for a Q&A session, which Nigel will lead. So to give a background to the rules, the MSC legislation was introduced way back in 2007, aimed at targeting perceived tax avoidance by those who provided their services through an intermediary, like a limited company, but who had little or no control over the management of their company. The origins of the legislation came from the widespread use of what were called composite companies, which were structures whereby there would be one limited company that multiple contractors would independently provide their services through and be shareholders of, but not actually be running a company. This allowed the individual contractors to be paid as shareholders, which prior to 2007 meant for a much more tax efficient way to be paid with no involvement in the actual management of the business. However, and probably more pertinent to the current situation, there were also providers who offered solutions which gave contractors their own limited company vehicle, and these also fell under the scope of the rules. So pre-2007, it was common for these individual companies to simply have a unique identifying number alongside the name of the overarching service provider. So in many cases, the contractors weren't even naming the business, and it was essentially an off-the-shelf company with all decisions managed by the provider rather than the contractor. There was obviously nothing wrong with this at the time, and some of those providers became very sizable, but the legislation was written in such a way that meant that they were firmly in its crosshairs, and most of them immediately changed their business model to reposition themselves as more typical contractor accountants. Whilst the legislation was introduced 15 years ago, HMRC has not widely or publicly policed it during that period. As I mentioned, the change in model adopted by a lot of those providers would have demonstrated to HMRC that the rules were essentially quite effective and acted as a deterrent or a preventative measure. And to date, we only have one piece of case law to refer to, which involves a firm called Costello Business Services, which we'll cover off in a bit more detail later. But HMRC's success with Costello appears to have increased their confidence, their appetite, and provoked a bit of a change in approach. So if we look at recent activity, HMRC have been very active with MSC compliance activity in the last few weeks, and that's been widely reported in both the industry and the national press. The activity is largely centred around contractors who have used the services of two specific contractor accountancy firms. Before we delve into the detail on the activity that we've seen in March, there's some merit in putting recent events into a timeline, which for some people spans over 5 years. During the period 2017 to 19, we know that HMRC started a low-level MSC campaign focusing on a handful of contractors who had been using the services of one of two specific contractor accounting firms. In some cases, the timing of the HMRC activity came almost immediately after the Costello Court of Appeal decision. Like many things, the MSC activity was affected by COVID-19, which saw HMRC pause all of their compliance activities. So we had all but no activity during that period. But throughout March of this year, HMRC issued over 1,000 Regulation 80 assessments for the 2017-18 tax year to both current and previous customers of the same two specialist contractor accounting firms, and not just the handful of individuals that have been formally investigated over the previous few years. The prompt for HMRC to do that would have been the time barring rules it has to adhere to. It was the last chance they had to keep the 2017-18 year open. So it's important to note that they are protective assessments at this stage, and they're still subject to HMRC concluding their stance on the activities of the two providers. Contractors only have 30 days to appeal these types of assessments from HMRC, so the deadline for the majority of those letters closes this week. From this point onwards, we could be looking at a lengthy wait for any kind of further update whilst HMRC go through the motions of the relevant appeal, review, and then potentially the tribunal process. So let's have a bit more detailed look at the legislation itself. In relatively simple terms, MSC is anti-avoidance legislation which targets individuals who provide their services via an intermediary which is controlled by a third-party service provider. In practice, that's very likely to be a contractor working through a personal service company or what they believe to be a personal service company and their accountancy provider. If individuals are found to fall foul of the legislation, then all of the income received by the individual via the intermediary must be treated as employment income. Even though the legislation revolves around the practices of the provider, the default tax liability rests with the contractor, which for contractors could run into tens of thousands of pounds, and that's what we've seen with the recent assessment notices I mentioned. As is the case with a lot of anti-avoidance legislation, the rules are broad, complicated, and as a result, not particularly widely understood. So over the next couple of slides, we'll explain the specific aspects of the legislation in a bit more detail. In order for the legislation to apply, there must be the existence of a managed service company and a managed service company provider who is involved, and that's a key term here, with the managed service company. So if we take each element in order, a managed service company and this slide will end up being quite wordy, so please forgive me, is a company whose business consists wholly or mainly of providing, directly or indirectly, the services of an individual to third-party clients. So that would essentially apply to all contractors. The individual supplying their services to third-party clients receives payments from the service company equal to the greater part of the sums received by the service company from the client for the services provided by the worker. Now, obviously, that wording is typically convoluted, but essentially, if the individual pays themselves over 50% of the funds received by their agency or client, this condition would apply. It also covers associates of the individual. So, for instance, if there was a spouse who was a shareholder and in receipt of salary and dividends, it would be the aggregate amount for both shareholders. And again, that's probably something that's going to apply to most contractors. The next condition is that the payments received by the worker are greater than they would have received if all of the payments were treated as employment income of the worker relating to an employment with the service company. Now, obviously, since 2007, there's been a significant levelling of the net tax position with changes to dividend tax in particular. But the main differential here will be the employer's national insurance, which would generally mean that payments taxed as employment income are always going to be greater. And finally, there must be an MSC provider, and that MSC provider must be involved with the company. So let's look at those points next. In respect of what an MSC provider actually is, in simple terms, an MSCP carries on the business of promoting or facilitating the use of companies to provide the services of individuals, and it's important to define both promotion and facilitation at this point. We can see the definitions in the boxes there, and you can see that they are both quite broad. So taken in isolation, this particular test could essentially include all specialist contractor accountants. They would definitely advertise a service for limited companies specifically and enable their creation and operation. And in fact, the Costello case confirmed that HMRC's view as to whether a company was an MSC provider boils down to two questions. Does the person promote or facilitate the use of the company, and does that company provide the services of individuals? But, and this is a very important but, simply because an organisation is an MSCP, it doesn't necessarily mean that their client companies are MSCs and will fall foul of the legislation. The crucial point in the legislation is whether or not the MSCP is involved with the contractor's company. If the MSCP is not involved, then the legislation doesn't apply. The criteria for involved is met if the organisation undertakes just one of these activities. Condition A is benefiting financially from the provision of services of the worker on an ongoing basis. B is influencing or controlling the provision of the services of the worker. It's important to mention here that control in this context is not the same as control that we talk about with I35. There's been a bit of confusion around that. C is influencing or controlling the way in which payments to the worker or an associate are made. D is influencing or controlling the company's finances or any of its activities. And E is giving or promoting an undertaking to make good any tax loss. That particular provision exists because some of the pre-2007 providers I mentioned incorporated I35 insurance into their overall service provision. There's obviously nothing wrong with holding insurance individually, but because the legislation was designed to target very specific types of model, tax loss insurance shouldn't be provided via or through an accountant. Now, as I mentioned, only one of these 5 conditions needs to be met for the MSC provider to be considered involved with their client. In practice, HMRC are likely to argue that more than one are present, which would give them more grounds to argue their case in a tribunal, even if some are then dismissed by the judge. In one of those two current live cases I mentioned, they are focusing on conditions A, C, and D. And I think particularly C and D are going to be the most common that we'll see in any activity from HMRC. The HMRC's arguments in that particular case are that condition A is met because there is an annual charge broken down into 12 monthly payments and a reduced fee for any inactive companies. They think that C is met because they believe that the provider provides a detailed, a default statement or a plan which outlines how the contractor's income should be distributed. And they think that D is met because the provider has a bespoke portal, which HMRC say that their customers couldn't operate without. Now, because we only have the Costello case as case law, and that was quite an extreme case, and I'll talk about that in a minute, there's no black and white answer at this stage as to whether HMRC are right or wrong in their arguments. This is why these particular cases are almost certainly going to go and proceed through the tribunal system, which is where HMRC's arguments can be tested by judges, and if they go far enough, new precedent set, which in fairness is what the legislation really needs. When a case is caught by the MSC legislation, the biggest impact is, unsurprisingly, a financial one. So the tax liability that will become due. The risk to the wider supply chain is that there's a debt transfer provision, which gives HMRC powers to recoup the liabilities from alternative parties if the contractor, and by that I mean either the limited company or the director, is unable to pay. And that could see the debt move to the managed service company provider, so the accountant, the directors of the managed service company provider, but then even agencies who have been involved in the process. And because of that aggregation of multiple liabilities for a managed service company provider or an agency, the value of the total liability, which could be relating to possibly hundreds or thousands of contractors, could obviously run into millions of pounds. And that's really why a lot of agencies have historically taken the MSC legislation very seriously. And you often see clauses in contracts giving some sort of indemnification that the contractor is not an MSC. In addition to the financial impact, if it can be paid by the parties, there's naturally a significant risk to the reputation of those MSCPs and agencies. And the other aspect to consider is the time, the cost, the effort, the stress, the wider business impact suffered by those accused of either being an MSC or an MSC provider during an investigation. Even if those cases are successfully defended, the potential damage done by the compliance process itself could be both significant, and the threat alone could potentially be a deterrent for those entering or even supporting the limited company contractor market. We've obviously mentioned the case involving Costello Business Services a few times, so let's have a quick look at that now. I've referred to it by the name of the MSC provider, but the case itself and the tribunal hearings were involving the contractors. The MSCP isn't a party to the proceedings. I mentioned that it was a bit of an extreme case, and they certainly weren't a typical contractor accountant, which in many ways makes it more difficult to compare this to the current compliance activity that we're seeing. So CBS was excessively involved in the financial management of contractors' companies, from deducting, holding and paying tax to HMRC for the individuals. They even earned bank interest on the tax that they held. They also it also extended to control of bank accounts, which the contractors didn't even have access to, and they instructed the level of dividends to be taken by the individuals. So naturally, that meant that CBS met several of those conditions for being involved with the MSCs. and the individual contractors, the contractor companies also met the 4 criteria of them to be considered MSCs too. Whilst only 5 contractors went through the tribunal process, the nature of that standardised service meant that they applied to all of their customers, and HMRC could apply the outcome to all of their customers. And obviously that meant that the case resulted in millions of pounds of liabilities. This is probably an obvious one, but for some it may be easy to confuse and merge both pieces of legislation with I35 and MSC, given that they both challenge the activities of contractors, and both of them are looking at redefining earnings as employment income. Given the complexities and the topical nature of both pieces of legislation, you can see the key points of each on the tables there. I35 technically takes precedence over MSC from a legislative perspective, meaning that if I35 applies to an engagement, then the MSC rules cannot. But obviously in practice, it's unlikely that those points would be considered as part of one process. The nature of the legislation and the fact that there are no clear tests and very opaque guidance means it's quite difficult for contractors to take protective measures, although there are potentially some proactive steps you can take. Take ownership of running your own company. There are decisions and responsibilities which should absolutely be yours as the business owner to make, especially when it comes to tax planning and remuneration. And the point around how income is distributed is key, and whilst it's natural to want to do this in the most tax efficient manner, it's important that you've taken your own due diligence in doing this and can demonstrate that you've done so. You should carefully consider what professional services you need from an accountant. You can absolutely use the advice of professionals like accountants in the same way that SMEs and corporates do, but it should be advice that you consider and make a final decision upon, and not any kind of instruction or an overly standardized approach. You can mitigate some of the risks through insurance for defense costs, or by engaging the services of a specialist advisor. It would probably be a challenge for a contractor to defend their position alone in the event of an MSC inquiry, but specialist advisors can give that expert insight and support that would be necessary if a contractor's position was questioned. And finally, it's important to keep an eye on any compliance activity and any cases that go to tribunal. Ultimately, until more cases go through the courts, the legislation does remain quite open and unfortunately subjective, but eventually contractors will have a lot more to go on when making decisions about who they engage to assist with their accounting requirements. So if we look at the key takeaways, MSC is very much on HMRC's radar, and whilst it might be some time before we see progress on the recent cases, it should certainly remain a focal point, given that the cases could have significant ramifications for the contracting industry. The risk to contractors and the wider supply chain is real, and it's potentially financially significant. So contractors, accountants, and even recruitment agencies do need to consider taking relevant due diligence. The legislation is complex, largely untested, and therefore education is imperative. Increased understanding can obviously help organisations appreciate the risks relative to their position in the supply chain. And then finally, engage with specialists who understand the rules and who can provide services that can support you in an investigation. Okay, so we'll move on to questions, and I'll introduce Nigel now. We've had a number of questions already, so let's have a look here. So we've got a question here. Will I reduce my risk by closing my company? Nigel?
The short answer is no. As Seb referred to in the slides, HMRC have this transfer of debt legislation where if they were to pursue the limited company for any additional liabilities and that limited company either didn't exist or didn't have the funds to pay, then the debt can be transferred to the director of the limited company, the owner of the limited company. So no is the short answer.
Yeah, and I think certainly what we've seen in the recent compliance activity is that HMRC have blocked the closure of companies who have been part of these two firms that we mentioned. So if there is any compliance activity involving your provider, then they may well block the closure. Okay, let's have a look. Could agents be caught by the MSC regulations as they fail to influence or control the provision of the services of the worker?
Again, as Seb touched on in the slides, yes, it simply depends on how involved they are with the PSC. The legislation is set up that there's numerous avenues HMRC can take to pursue liabilities, and subject to the involvement that the agency or the provider has with the PSC, then it is possible that they could also fall foul of this legislation.
Yeah, I guess what should be noted is that there are a couple of exemptions with the legislation, one of which relates to accountants who are providing services professionally, and one of which applies to two agencies essentially. But they're quite narrow definitions, and that there are other elements in the legislation that are yet to be tested. So I think in Costello, they tried to refer on, they tried to rely on the accountancy exemption, but they weren't able to do that. So there's still a lot that has been that remains untested. Technically, agencies could be exempt, but I think if if they were heavily involved in other elements of the contractors company, then HMRC would look past that. Okay, should contractors who used providers prior to 2007 be concerned? Since the loan charge penalised pre-legislation activity of contractors, will pre-legislation MSC usage also come into HMRC's crosshairs?
Well, the honest answer is we don't know, but we don't believe so, because obviously the current businesses that are under investigation, HMRC are going back to what's known as the last in-date year. So because the inquiry started a few years ago, then up until the 5th of April of this year, they could raise assessments for the 2017-18 tax year, which is what they've done as a sort of preemptive strike, and to protect their liabilities, protect their interests. So we don't believe they'll go back further than 2017-18. And then obviously, if the inquiries are still ongoing this time next year, or before the 5th of April next year, they will then raise protective assessments for the 2018-19 tax year. So we don't think that they will go back any further than 2017-18.
I've had no acknowledgement of my appeal having been received. I followed up my email by sending the letter by registered post. What more can I do?
Yeah, you're suffering from what most people suffer from when they try to get in touch with HMRC, is that HMRC, in any form of correspondence or investigation, set time limits for clients or their representative to respond. With appeals, it's 30 days. However, HMRC don't correspond to any time limits. They basically will reply in a time that suits them. If you've actually submitted the appeal, and if you've done it by registered post or recorded delivery, so you've got a record that you've submitted, then I really don't think there's much else that we can do. Obviously, HMRC would have had somewhere in the region of 1,000 appeals being submitted over the last few weeks. And so they will have a backlog. I know they're starting to acknowledge appeals. We've submitted appeals on behalf of clients, and we're starting to see now that HMRC are acknowledging those appeals. We're getting those letters coming through. but they haven't all come through yet. So it will happen, but it will happen in the time frame set by HMRC.
Okay, got a couple of questions around the kind of offsetting of tax. So I know that, could you give an example of what the potential liability would be? I think just in pounds and pennies, maybe, just so we can give people an example of what that would be.
I mean, if, for example, HMRC were assessed 2017-18, but as I touched on a moment ago, before the 5th of April next year, they will assess 2018-19, as that's the next year that could fall out of time. So if, for example, you were a contractor who was earning £500 a day, 5 days a week, 48 weeks a year, that would give you an income of £120,000. Now, if you're caught by the MSC legislation on that £120,000 income, presuming you had the full personal allowances of £11,850, you would pay tax of just over £36,000. You would pay employees' national insurance of just over £6,000, but you would also pay employers' national insurance of just over £15,000. So effectively, your total liability would be almost £57,000 on a £120,000 income.
But you would offset.
Yes.
And there's a couple of questions on that. So perhaps could you explain how that would work?
Effectively, without going into too much detail, effectively, as an employer, which is what effectively you would be under the MSC legislation, your limited company would be your employer. A deduction in the accounts for any employer is the wages, the salary paid to its employees. So if you, for example, had a basic salary of £10,000 in your accounts currently for 2018-19, but HMRC then changed that to £120,000, you would have an additional £110,000 worth of expenses that your company would claim, which would therefore reduce the company's profits by a similar amount, which in effect would mean that your company would be due a tax refund, a refund of corporation tax, because it would have paid too much. In addition, the dividends that you would have taken, you would have paid tax on, you would also be due a refund of the tax due on those dividends. So effectively what would happen is HMRC would work out your pay-as-you-earn liability, and say, for example, it was the £57,000 I referred to, and then against this, they would set any corporation tax overpayment and then dividend overpayment, leaving you with the net figure to pay to them.
And which would reduce that.
Yeah, obviously, I would say if that figure was, say, £30,000, it would mean your liability of £57,000 would reduce down to £27,000.
Which is still not insignificant, but it's a reduction.
And obviously, HMRC also charge interest on those amounts as well.
Yeah. I have a direct contract with a client with no agencies involved. The client is considered to be a small company, i.e. less than 50 employees and less than 10 million turnover. Am I correct in assuming that the new I35 guidelines and the MSC risks do not apply to me?
Yeah, Chapter 10 doesn't apply. You still fall under Chapter 8 of IT in respect of I35. And based on the very limited information you've given us, I would say that it's highly unlikely the MSC legislation would apply, because for MSC legislation to apply, it's how much control you have over your own limited company. So if you've set the limited company up, if you decide how much salary you take, how many dividends you take, if you decide what work you undertake, what work you don't take, etc., then if you basically control your own business, then it's unlikely the MSC legislation would apply. The
key thing there, I think, is the relationship that you have from an MSC point of view, is the relationship that you have with your accountant, if you have one. I35 and MSC are completely different. Obviously, they do have similarities in the way that it relates to employment income, but it's completely different relationships that HMRC are looking at. So I35 is looking at the relationship between you and your client, whereas MSC is very much the relationship between you and whoever is assisting you in running that company. So the small company exemption is completely irrelevant when looking at things from an MSC point of view. I've always operated inside I35 via my limited company. Could I be investigated for the 5% dividends I was allowed to take using this investigation? Using this legislation, sorry.
No. Essentially, you're pretty much taking the vast majority of your income as pay as you earn salary, which is exactly what HMRC want as part of the MSC legislation. And again, as Seb touched on in the slides, if you're taking more than 50% of the income received as dividends, then that would maybe trigger a concern by HMRC. But you know, the fact that you're taking 95% as pay as you earn salary, you would have no worries in that area.
And I think because I35 takes precedence, the fact that you're operating inside I35 would mean that MSC couldn't apply anyway. So I think it's pretty safe there. Will simply pay my accountant with a monthly standing order breach point A. Point A was about the benefiting on an ongoing basis from the provision of the services. Now, this is one of those points that's yet to be tested. Costello had a fee structure which was based on a percentage of the invoice amount that the contractor was generating, which is obviously very different to how the majority of accountants would work. And I think because there was that percentage basis, it meant that Costello were very much benefiting from an ongoing basis on the provision of services by the individuals. Beyond that, there was no, we don't know. I would say that's certainly a basis of the argument HMRC are using, but I think of the three that they're targeting this particular firm on, that's certainly going to be the weakest. They've probably added it in there just to bolster their argument, but I'd imagine that paying a monthly fee for accounting services, even if it's an annual fee divided by 12, isn't going to hold much water with judges.
The other thing to bear in mind is actually within the employment status manual, HMRC do give some definitions of what they class as non-MSC providers. And one of those is a firm of accountants carrying on a business of being accountants, irrespective of the percentage of the client base, which is individuals operate through service companies. So if your accountant effectively just does accountancy work for you, you know, submits your tax return, draws up your accounts, then it's highly unlikely that they would be classed as an MSC, a managed service company provider.
Okay. If I am a contractor with my own limited company, having my own accountant, but in order to provide services to the end client, I have to submit the timesheet approved by the end client and recruitment company. I don't think, and then since which year is MSC applied? I think that, I guess that's a self-billing type service, as long as the accountant isn't getting involved in the timesheet approvals or that kind of process, and I don't think that's an issue, and that's not an issue. And since when is MSC applied? So it came in 2007, and ultimately, under normal circumstances, HMRC can go back 6 years, which is why we're seeing this 2017-18 protective assessment that's happening at the moment. Is it worth moving to a kind of mom and pop accountancy firm?
Well, we can't really advise as to what accountants you should and shouldn't use, but as I've touched on earlier, if they are accountants who are just doing accountancy work for you, i.e. submitting your end of year tax return, drawing up a set of accounts for you, then it's unlikely that you would fall foul of the MSC legislation.
Yeah, I mean, I think what I would say is there's no, at this stage, whilst there's a lot of discussion about this, obviously everyone needs to be aware of it. I wouldn't advise that people panic and move accountants. I think it might be worth seeking some sort of clarification from your own accountant that they're aware of it firstly, but have also taken kind of steps to ensure that you know, they understand the guidance and aren't potentially contravening any elements. Let's have a look. Have there been follow-up I35 claims to clients of Costello services or other such accountancies? So you're not aware of anything?
No, none that we're aware of, no.
And ultimately, I don't know, given that they would have already taxed that income as employment income.
Yeah, I mean, the only way that the possibility exists that if HMRC carried out an MSC inquiry and deemed it not to be an MSC, in theory, they could then look at the I35 legislation, but it's highly unlikely that they would go down that route. I mean, as Seb touched on earlier, Chapter 10 of the off-payroll rules takes priority over MSC anyway. So, we've not heard any in respect to Costello, and I can't see why HMRC would even do that.
Does the fact that of the 2 contracts I undertook in this time period were sourced, 1 directly with the client and 2 via a recruiter, prove that I am not an MSC?
Again, without fully knowing the fact, I mean, if you're, shall we say, operating through a traditional PSC model where you have a contract with an agency and the agency has a contract with their client, and you carry out work for 6 months and then move on to another contract, then it's unlikely that you would fall foul of the MSC legislation. But again, without knowing the exact details, it's hard for us to say.
And again, it's all more about, it's less about the contracts that you undertake and more about just that relationship with your accountant. I mean, I think as obviously one of the elements of it is that they would be controlling the manner in which you or the manner in which you provide the services. But I think that's the least likely one that HMRC are going to pick up on, to be honest. So I think, it's less about the contracts that you undertake and more about how things work in a daily basis with your accountant. If the accountant is only involved in submitting PAYE, VAT returns and finalising of the annual accounts, would the MSC legislation apply? Very unlikely.
Yeah, I mean, as I said, in the HMRC status manual, they say basically if the accountant is carrying on the work of an accountant, then, and as I touched on, submitting returns, drawing up set of accounts, it is very unlikely that the legislation would apply.
How do we find out which accountants are being investigated? Now, I've not mentioned either of the firms on this webinar, but it's quite easy to get them on the internet.
Yeah, I would say a Google search will almost certainly give you that information.
Yeah. From a terminology point of view, would a consultancy like Deloitte, for example, who use contractors, fall into this bracket? Not really, because Deloitte, in the context that you're talking about, presumably the client of a contractor, they're not providing any kind of accountancy type service. They're not involved in the running of that contractor's limited company. Obviously, from an I35 point of view, then they're definitely, they'd fall within the scope from an off payroll and an I35 point of view. How will I35 determination status change in the future, i.e. government or HMRC strategy? So that's not an MSC question, but you can...
well, obviously we've had the off-payroll rollout in April 2021, which was delayed because of COVID. That's aimed at medium or large businesses, which effectively, for someone to be a medium or large business, it's 2 out of 3 criteria: 10.2 million turnover, 5.1 balance sheet, or more than 50 employees. And that's in place now. What HMRC intend to do in the future, we don't know. We have our ideas. I mean, personally, and this is nothing, I've seen nothing, I know nothing, I'm not privy to any inside information, but it's just my personal view. Based on HMRC activities, I expect they would roll out the off-payroll rules to small businesses, and they may even look to roll out a similar version of the off-payroll rules to sole traders as well. But HMRC's compliance activity has increased. They are carrying out off-payroll inquiries, they are carrying out inquiries into managed service providers, they're carrying out inquiries into supply chain due diligence, and they're carrying out inquiries into managed service company providers. So clearly HMRC have increased their activity in the last year or so, and that's not going to change. If anything, that will just increase more and more as the months and years go by.
Yeah, they've obviously made their life easier with the reform to I35 because they can essentially go after the liabilities of hundreds, thousands of contractors under one piece of compliance activity. And that's very similar to MSC, really. They know that the practices of an accountant will apply to all of their clients, probably, or the vast majority of their clients. So they've made their life a hell of a lot easier than it was previously. What is the process with regard to Qdos if one was to receive such a claim from HMRC? There's a few questions actually about insurance and so on here, so probably easiest to cover that off. So we historically our insurance policies didn't include coverage for MSC inquiries, but we're making adjustments to that at the moment. So if there is any kind of letter that you receive from HMRC in the first instance, send it to us. It will be included as part of the tax inquiry insurance coverage, which means that there'll be full representation and defence. Similarly, we're dealing with a lot of the clients of those two firms, and we're doing that at no charge if they're an insured client of us. But yeah, if you get any kind of letter from HMRC relating to the managed service company legislation, send it into us immediately, and we can obviously represent you and provide any relevant advice.
Yeah, as Seb said, we've already got a number of clients that we're representing, and we're also in discussions with the two businesses in question as well. So yeah, if you do receive a determination or a notice or a letter from HMRC, then just please let us know.
Here's a nice one for you, Nigel. Can you explain how HMRC intend to justify charging employee NI and employers NI?
Well, effectively, it's exactly the same as is within the I35 legislation. HMRC deem you, the worker, the director, as an employee of your own limited company. So as an employer, which is what your limited company would be, you have to pay employers' national insurance, as well as being an employee, you have to pay employees' national insurance. So it's effectively, you're employed by your own business, therefore the normal employment taxes apply.
Yeah, I mean, we were just discussing before we came on that it's a weird bit of legislation,
yeah,
and at the moment it's not a particularly nice bit of legislation just because it's so untested and so open. And I think a lot of people kind of rested on their laurels with it, really, because HMRC seemingly were doing nothing. But I think the thing we need to remember, it came in 2007. Then the Costello case actually began probably 2011 or 12, but it took that long because it went through first tier tribunal, upper tier tribunal, then the Court of Appeal. It took so long, and I think HMRC were probably waiting for that result because they knew that Costello was, cut and dried essentially from their point of view. And as I said, those more recent cases that we've had, some letters were sent within weeks of the Costello Court of Appeal hearing. So it seemed very much like HMRC were banking on that result and then waiting for it, and then they were going to launch their attack. So whilst it's been publicly quite quiet, I think HMRC have just been biding their time with MSC. But there have been other instances of liabilities. I know there's one firm that dealt with the lorry drivers who were hit with liabilities. It didn't go through the tribunal system, but they haven't been completely inactive. But it isn't a particularly nice piece of legislation, and obviously it's rearing its head at the moment. And
the thing is to remember as well is it is a curious piece of legislation, but it's sort of this inquiry process will not be quick. It will be very slow going, and I don't expect it to be resolved this year or possibly the year after.
No, yeah, it's going to take, and obviously if these cases do go through that tribunal process and go through the 3 steps of tribunal, then I mean,
years and years.
Yeah, unfortunately, that's just the way it works. Same with I35. How far does this go back retrospectively? Some references to some they look like avoidance schemes. I won't name them. Am I getting confused with the loan charge? So yeah, at the moment, let's not consider this in any way kind of retrospective legislation in the same way that the loan charge was. This is very much more like I35. You know, HMRC they're looking to go back 4 to 6 years. Obviously, it differs from I35 because I35 is always on a contract by contract basis. So you may have a contract for 18 months with a client. HMRC look at that 18-month contract, whereas obviously with MSC, they're looking at the period that you've been with the particular provider. So they can extend it. And with these existing cases, we've obviously got those protective assessments for 18-19, but actually the live inquiry is into a 4-year period, I think, isn't it?
The inquiry period is 6th of April 17 to the 5th of April 20.
20, yeah. So
it's a 4-year period, and the protective assessments that they've sent out recently have been for 17-18. So they, as I said earlier, it doesn't appear, and I don't believe they're going to go back any earlier than that.
It's worth also pointing out that HMRC have been pretty slapdash in the way that they've gone about sending these appeals out.
Yeah,
you know, we've had instances of contractors receiving letters with an assessment, a financial assessment on who actually left these providers sometime before 2017. So I don't know where they got their information from, but it's not really particularly impressive. Does a limited company with an accountant become trapped as an MSCP? Again, depends on the relationship and the services that the accountant's providing. I mean, so obviously with those cases, do we have any idea when the tribunals are going to be, or?
No, I mean the thing with tribunal is the fact that at the moment, per the acknowledgement letters we've been getting in respect to the appeals, HMRC will be selecting test cases, and we believe the number is going to be 5 test cases, and then those cases will be where the businesses in general and HMRC make their arguments as to why they don't believe they are an MSCP or MSC, and HMRC will make their arguments as why they do believe they are. And if those arguments can't be resolved between the clients and the HMRC, then obviously the first option will be for it to be heard at the first tier tribunal. But any appeals that go to tribunal are always listed by the appellant, not by HMRC. HMRC don't have any say as to whether a case goes to tribunal or not under the rules that were built in probably 12 years ago. But my belief and understanding at the moment is if a case even were to be listed for tribunal today, you probably wouldn't get a tribunal hearing this side of Christmas because there's such a backlog because of what's happened in the last few years.
Does the legislation, the MSC legislation, apply to doing services to EU companies? It's kind of irrelevant, isn't it?
Yeah, I mean, effectively, if they don't, if they're based at, I mean, I suppose it's similar for the off payroll rules. If the company is based solely overseas, as in 100% overseas, no permanent establishment in the UK, then it's on the individual contractor to assess their own status. So I don't think the MSC legislation will apply for a company that's got an engager, if you like, that's based overseas and has no presence in the UK.
But I think if the account, regardless of where the contractor is providing their services, if they're taxed in the UK and their accountant is in the UK, then I think that.
Yeah, there would be a consideration there. But if the contractor is purely working for someone who's wholly overseas, then no, but they would still have to obviously consider IR35.
If they're a UK, if the contractor is a UK taxpayer and the accountant is based in the UK, it's kind of irrelevant as to where the contractor is providing their services. It's all about where they're domiciled for tax purposes. Are you able to disclose the names of the 2 contract companies yet? We'll leave that for now. If HMRC determine a director is able to pay, if they're not able to pay, how do they decide to transfer debt to an accountancy?
effectively, the first port of call, worst case scenario, is the PSC, the limited company. If the limited company doesn't have sufficient funds to pay, they will then look to transfer the debt to the director of that limited company. If the director of that limited company can't pay, simply just doesn't have the financial wherewithal, at that point they would look to transfer the debt to the managed service company provider. So so there would be certain, I mean, effectively, in a nutshell, the limited company and the director would have to prove that there were no funds available and those funds couldn't be raised, there was no credit available, whatever it might be. HMRC, in any form of investigation, if there is a liability, will always, they have a form called the Statement of Assets and Liabilities, which is literally that. You list your assets, you list your liabilities, and if your assets exceed your liabilities, then you've got money available. And HMRC will always ask for that so that you can show whether you can or cannot pay the liabilities that they're seeking.
Does paying an accountant to do your taxes flag criteria A, even if the other criteria for MSCP doesn't apply? So criteria A was benefiting on an ongoing basis. No, I don't think so. I think that's more about HMRC are likely to be looking at the manner in which the fees are paid from the contractor to the accountant. Like I mentioned with Costello, it was based on a proportional percentage of the invoice amount, which is very uncommon. And obviously, if you ever do come across a firm that is offering that type of arrangement, I would probably steer clear. With these more recent cases, they're looking at kind of inactive fees, and the fact that if the contractor's not working, then there's a reduced fee for the accountancy services. That seems to be their focus. Again, there's no guidance or test cases or case law on that, so I think that's just potentially a weak argument from HMRC, but just simply paying somebody to do your taxes, certainly, I guess any type of business will do that.
And we don't believe that if that was the only criteria that was there, that HMRC would actually pursue that under the managed service company legislation, because in the letters we've seen, they've quoted 3 of the 5 criteria. So I sincerely doubt they rely on just one.
I think we'll have a final question now, and it's a nice one. Why is HMRC so intent on wrecking the contracting industry? Nigel, your views? Because
HMRC want everyone to pay all the taxes that they should pay. And HMRC have this misconception of the contracting industry that they're avoiding tax. But effectively, what people are doing is paying the tax within the guidelines of the legislation. But as you've seen earlier from my very brief overview of what you would pay on a contract of £120,000, clearly if you're paying pay-as-you-earn employees' national insurance and employers' national insurance, you're paying HMRC more taxes than if you're paying yourself a low salary indifference. And the HMRC are basically, they need all the money they can get. So that's why they pursue this, because none of us are naive. There are 1 or 2, shall we say, unscrupulous people out there who don't conform with the legislation, but they're a very small minority, not the majority HMRC seem to think.
Okay. Right, so it's 11:59, so just about hit the full hour. Thanks once again for joining this morning. We'll be sending out a recording of the webinar to everyone who registered. If you asked a question, I'm sorry, there are a lot of questions on there, so if you did ask anything that we didn't have time to answer, please just drop us an email or give us a call, and we can come back to you offline. So yeah, thank you everyone, and have a good afternoon.